Look, man, I'm hitting you with that's 2 for 1 on the stock today. Holla at your boy on this one. Checkmate 007 coming at you. I'm gonna break down some of them terms. Now let's go.
Let's change the grill.
Life is like a movie. I die, I organize. Everything I do's revolutionize. I build what's good for the whole damn hood. Study G's like these. Really think you should.
Look, man, Checkmate 007 coming back at you. I told you I got you. This is episode 14 right here. You know what I'm saying? I'm breaking down the basic stock terms. Look, bro, anybody can do it like this. Pull up any stock right now on Yahoo, no, on Google, and they usually pull up a screen for you with a couple terms. I'm gonna bring one up right here. Now, you see the terms listed. I'm gonna go through them one by one. We're gonna make it real quick, make it real simple. Now, open. The breakdown of it is the price as the market opens, which is for Wall Street, 9:30 on the Eastern Coast, Florida, New York. Now, there is a pre-market trading which starts at 4:30 in the morning, pre-market on the Eastern Coast. But then traders don't really touch the market until about 8 p.m. You'll start seeing some pre-market movement before they really start getting moving about 9:30. That's open for you. What price it opens at, but they can manipulate it before it opens. Now high. Now this is relatively straightforward. Now the high is depending on the time frame of what you're looking at the stock. If you notice, we have different time frames. Now, just because it was the high yesterday, don't mean it was the high last week, last month, or last year. Those are usually some of the time frames, but that is your high for that time period. Now, the low is the exact opposite. It shows you the bottom price the stock reached in that particular time frame. You want to pay attention to both these terms. They are your extremes. Telling you how low and how high it done went and whether or not it's going to break them. Now, look, let's bring it back. We finna touch the next term. Market cap. This one right here, pay attention to me real quick, because this one right here is really special. It shows the value of a company through the outstanding stock, which I explained in episode 13, which is usually a simple formula, which is stock price times outstanding shares. Such as, let's say, it's $100 a share, and you have 3 million shares. Well, that gives you 100 times 3 million, which will bring you to 300 million. Now, let me tell you why this is special. Now, 300 million sounds like a lot of money to have outstanding that can be redeemed. But small cap starts at 300 million. All the way up to 2 billion. That's a small cap company. Those are companies that are generally more volatile. You'll see a lot more gains that way. And they start to even out a little bit more when you get to mid cap. That's medium in the middle. 2 billion to 10 billion. You start getting your big corporations here. You know what I'm saying? Some of your big players. But even then, we can bring it up. Now, large cap starts at 10 billion and there is no cap. This is where you get your Apples, your Tesla, your Samsungs, some of your firms. You start getting the real crazy funds here. So you have to really pay attention to market cap. Look, man, PE ratio. I'm glad you stayed with me. Now, it's a measure of how much investors are paying for every $1 of the company's earnings. Now, let's break this down a little bit more. This is share price divided by the earnings per share. Now, this is a quick example. Let's say you have $100 divided by 10. That's what we're going to do. Share price is 100. Earnings per share is $10. That means if you do the math, that's it is making every $10 per every dollar spent. Which sounds great, but this figure here is really used as a benchmark, a bar, basically, to measure the score of how well the company is doing in that sector of the industry. Such as if you measured it with Apple, you would want to measure them against Microsoft. If you see it with Tesla, you might want to do it against Chevy or Ford. You know, so when you're in that industry, you have to really be paying attention. Maybe if you did Apple, you would do Samsung. You know, these are some of the ways to understand how to measure benchmarks against each other when you're trying to really build up your diversification in portfolios. I mentioned that one back on episode, I think, 10, 11. Now, we're going to move on to the next one. Dividend. Y'all know how I feel about dividends. Episode 6, when I was ripping up the luxury of Jordans and Birkin bags. Now, it's the money paid out per share for holding shares, which means they're giving you money as a thank you for allowing us to use your capital. I've already done one on the capital. Please go see that one. That was number 2 in financial rants. So the yield of dividend is representing the percentage they paid per share. Such as if the share was $100 and they paid 60% of a percent of a $100 share. That means they paid 60 cents out per share. And if that's declared quarterly, talked about this before, quarterly, sounds just like what it is, 4 times a year. You know what I'm saying? 4 seasons. Spring, winter, summer, fall. And you owned 100 shares, okay? That means that you'll get 4 paychecks throughout the year of $600, equaling an extra $2,400 just for owning the shares. That's why people own stock. A lot of people do it for the dividends and the growth. Now, previous close. This one is very self-explanatory. It's the price of the stock when the market closed for the previous day. And then you have the 52-week high. Now, we remember going over high. 52-week is just trying to measure you out a moving average. Because there's 52 weeks in a year, give or take. So they're giving you the 52-week moving average of the high. This is a very important statistic to look at, especially when you're looking at the longevity of a stock. And then you have the next one right beneath it, the 52-week low, which gives you the same thing, which is the lowest amount the stock has been on a moving average of 52 weeks for a year, basically. Now look, stay with me right now, right? I'm bringing you an extra volume. This is very important when trading. Stock, forex, any equity, any security. It's important to figure out what the volume is. Is the amount of stock generally traded, because we're dealing with stocks, the amount of stock generally traded in a particular time period. We pay attention to your time periods. That is measured on generally a daily value, but can vary. Generally, the more stock that's trading, the better is the rule of thumb, because they have more volatility. You can get bigger gains, whether you bet against it or for it. Look, raising the volume on them stock terms, that's determination. Like I did that right there. Checkmate 079. Bop!
I organize everything I do's revolutionize. I build what's good for the whole damn hood.